Stop waiting for silver to hit $100 again. By the time it does, the greatest wealth transfer of 2026 will already be over. Right now, there is a signal hiding in the gold to silver ratio that hasn't appeared in 14 years. It's a once-in-a-decade anomaly that proves the recent crash was manufactured, not fundamental. I'm going to show you why the banks are buying while you're panicking, and exactly what happens when this 2012 ghost signal fully loads. Wednesday, February 18th, New York time. Drop your date in the comments below so I can see exactly where you're watching from. And if this kind of work means something to you, hit subscribe and comment George Williams. It genuinely helps more than you know. Let's get into it. Silver is trading around $74 per ounce as of this week. And yes, that's down from where it peaked above $94 in January 2026. But here's what's wild, and what most people are completely glossing over. A year ago, silver was sitting near $32. That means even at today's so-called pullback price, silver has more than doubled in 12 months. That's not a trade, that's a structural shift, and understanding why it happened is the only way to understand where it goes next. Let me start with the thing that nobody in mainstream finance is talking about clearly enough. Silver just posted its strongest annual performance since 1979. Let that sink in. We're talking about a metal that's been dismissed, mocked, and ignored for decades, quietly pulling off a move that hasn't been seen since disco was still on the radio. That's the signal. That's the thing you should be paying attention to. So what exactly happened? In 2025, silver climbed from around $29 at the start of the year, powered through resistance level after resistance level, broke past $75 by December, and then shot above $94 in January 2026 before pulling back. That entire run, about 165% from January 2025 to the January 2026 peak, happened because two things crashed into each other at the same time. Industrial demand hit record levels, and investors suddenly realized that silver, compared to gold, was absurdly cheap. Let's talk about the gold to silver ratio, because this is one of the clearest signals in the entire precious metals world. The ratio is simply how many ounces of silver it takes to buy 1 ounce of gold. Historically, that number has hovered around 50 to 60. For most of 2024, it was sitting above 90, meaning silver was historically cheap relative to gold. When that ratio is extreme like that, one of two things happens. Either gold falls or silver catches up fast. In 2025, silver caught up. The ratio compressed from around 90 down to roughly 62 by year-end, and by January 2026, it briefly broke below 50, the first time that had happened since 2012. That's the rare signal. That's what hasn't happened in years. Now the ratio sits near 64, and the question every serious market watcher is asking right now is whether that ratio continues compressing, which would mean silver outperforms gold again, or whether it snaps back, which would mean silver underperforms from here. To understand which direction things might go, you have to understand what's actually driving silver's demand. And this is where the story gets genuinely remarkable, because silver isn't just a monetary metal anymore. It hasn't been for a while. More than half of all silver consumed every year now goes into industrial applications. Not jewelry, not coins, industry. The single biggest driver is solar panels. Every solar panel contains roughly 20 grams of silver, about 2/3 of an ounce, because silver is the most electrically conductive metal on Earth. You can't replace it without sacrificing efficiency. And global solar capacity just keeps expanding. The United States alone is expected to add 70 gigawatts of solar capacity in 2026 and 2027 combined. To put that in physical terms, a single gigawatt requires about 3.1 million solar panels. So America's solar expansion over the next 2 years will consume something like 143 million ounces of silver, just from the US. And China, which installed more solar panels in the first half of 2025 than the rest of the world combined, is still accelerating. Electric vehicles add another layer. The average traditional car uses about 15 to 28 grams of silver. A battery electric vehicle uses 25 to 50 grams. As EV production scales globally, with 14 to 15 million units expected in 2026 alone, that translates to another 70 to 75 million ounces of silver demand from the automotive sector. Then pile on top of that the build-out of data centers, 5G infrastructure, and AI hardware, all of which depend on silver's conductivity. And the Silver Institute, the most authoritative body tracking this market, just published their 2026 forecast, confirming that this will be the 6th consecutive year where global silver demand outstrips total supply. The projected deficit for 2026 is 67 million ounces. For 5 straight years, the world has been consuming more silver than it mines. Inventories have been drawn down year after year. That kind of sustained structural deficit doesn't reverse overnight. It takes years of new mine investment to fix. And here's the critical constraint. More than 70% of silver is produced as a byproduct of mining other metals like gold, copper, and zinc. You can't just turn up silver production like a tap. When those base metal operations aren't expanding, silver supply stays tight regardless of what the silver price does. JP Morgan's analysts are forecasting silver to average $81 per ounce for all of 2026. That's more than double silver's average price in 2025. The Silver Institute's own metals-focused team backs this up by pointing to persistent physical tightness and strong investment demand as the structural floor. Now let's talk history, because the pattern playing out right now has a precedent, and it's both exciting and worth approaching with respect. The last time silver posted a move anything like 2025's was in the late 1970s into 1980. Back then, silver ran from around $6 per ounce to nearly $50, an 8x move, driven by the Hunt brothers attempting to corner the entire silver market, combined with runaway inflation, a weak dollar, and genuine supply panic. Sound familiar in some ways? It should. We have supply deficits. We have institutional money piling in. We have a weak dollar environment. We have inflation concerns that won't fully go away. But here's where the comparison gets complicated, and where you need to be careful. In 1980, the COMEX exchange stepped in and changed the rules, specifically restricting margin buying of silver, which triggered cascading forced selling that erased 90% of silver's value within 2 years. That kind of regulatory intervention is always a risk when a market moves this fast. In January 2026, when silver shot above $94, the iShares Silver Trust ETF, the main silver fund that most retail investors use, saw trading volume approach $40 billion in a single session. That's roughly the same volume as the S&P 500 ETF on a busy day, 20 times its historical average. Moves like that attract attention, not just from buyers, but from regulators and from smart money that starts looking for the exit. The pullback from $94 down to the current $73 to $74 range was sharp, a 35% drop in a matter of weeks. That kind of volatility isn't abnormal for silver. It's actually characteristic of the metal. Silver moves harder and faster than gold in both directions, and that's part of what makes it both compelling and dangerous. The US dollar and interest rate environment matter enormously here too. The Federal Reserve cut rates 3 times in 2025, and there's a better than 60% probability, according to current futures market pricing, that we get at least one more cut by June 2026. When the Fed cuts rates, the dollar tends to weaken, and when the dollar weakens, commodities priced in dollars, silver included, tend to get more expensive. Lower interest rates also reduce what's called the opportunity cost of holding silver. In plain English, when your savings account or treasury bonds are paying you very little, a non-yielding asset like silver becomes relatively more attractive. That dynamic has been one of the tailwinds pushing institutional money into the silver market throughout this cycle. So where does silver go from here? There are 2 honest scenarios, and the truth is probably somewhere in between, but each one deserves to be taken seriously. In the bullish scenario, the Fed delivers another rate cut in mid-2026. The dollar softens. The gold-to-silver ratio, currently near 64, continues to compress back toward its historical median of 50 to 60, which would put silver somewhere in the $90 to $100 range, assuming gold holds near current levels. Industrial demand remains structurally elevated. Solar and EV production don't slow. Physical market tightness pushes lease rates, the cost of borrowing physical silver, to elevated levels, signaling that actual metal is genuinely scarce. ETF inflows continue, and the 6th consecutive supply deficit forces buyers to compete harder for a shrinking pool of available metal. In that environment, JP Morgan's $81 average price for 2026 looks conservative. The more aggressive analysts, and there are credible ones, see silver retesting and eventually surpassing the $94 January high. In the cautious scenario, something shifts. Maybe the Fed reverses course, perhaps because inflation proves stickier than expected, and rates stay higher for longer. That strengthens the dollar and takes pressure off silver. Maybe an economic slowdown in China, which consumes over half of global industrial silver, dents solar and EV manufacturing. Maybe the photovoltaic industry accelerates what it's already quietly doing, using less silver per panel through what engineers call thrifting and substitution. The Silver Institute's own data already shows PV sector silver demand pulling back slightly in 2026 due to improved manufacturing efficiency, even as overall solar installations expand. If industrial demand disappoints and the monetary tailwinds fade, silver could drift back toward the $60 range and frustrate bulls who are positioned for another leg higher. Here's what's true regardless of which scenario plays out. The supply-demand picture in silver is structurally different from what it was 5 years ago. 5 consecutive deficits have chipped away at the buffer that above-ground stockpiles used to provide. The green energy transition isn't reversing, and the gold-to-silver ratio compressing to its lowest level since 2012 is a signal that the market itself is telling us something has changed. Whether that change means silver is in the early innings of a decade-long repricing, or whether it means we just witnessed a speculative blow-off that needs years to digest, that's the question the market is sitting with right now. And honestly, that tension is what makes this the most interesting place to watch in the entire commodity complex. The metal has your attention. The question is whether it deserves your patience.